I recently forced myself to watch 100 hours of YouTube videos about Bitcoin. And today, in this video, I will share with you what I learned. I will go straight to the first point, which is also my biggest pain. All the videos I watched are only about being either a Bitcoin supporter or a Bitcoin detractor. There are only two categories, the haters and the fanboys. Like most forms of fanatism, many supporters tend to endorse their ideas uncritically. In most cases, there is a lack of genuine financial advice or practical strategies that could be of any real benefit. 50% of the channel I watched try to convince me that the Bitcoin is only scam, and the other 50% try to convince me the opposite. None tries to position the Bitcoin in an investing portfolio in a balanced and rational way. In fact, if we position it in the right way, this would clarify its role in a common portfolio and smoothen many annoying and senseless discussions. The real question is, what is the right place of the Bitcoin in a portfolio? In the investing world, in fact, there is a wide range of very complex and speculative instruments like leveraged ETF, derivatives, binary options, junk bonds, CFDs, you can short sell a stock, and so on. And my question to you is, would you go all in with the derivatives or junk bonds? I guess not. Under this aspect, Bitcoin can freely take its place in this high-risk investing category, and if positioned correctly, it will become a speculative asset as many others. The question is only how to handle a product with this high risk and high volatility. Yes, because Bitcoin is a very volatile instrument. A study by Forbes, I leave the link in the description here below, analyzed the volatility of the Bitcoin in comparison with other assets in the last 10 years. The result is that the Bitcoin is 4.8 times more volatile than the S&P 500, 5.3 times more volatile than gold, and 3.1 times more volatile than the Apple stock over the past decade. Personally, I would not give more than 5 to 10% space in my portfolio for such a volatile product. But again, this is a personal choice, and depending on the risk tolerance of each of us, the decision can be way different. The other majority of the videos I watched are about speculating about the Bitcoin big bubble and if it's going to explode or not. Again, the discussions are not so constructive, and they do not help to take the right decisions and analyze the problem from the right perspective. How much is this relevant in our investing strategy? Is the Bitcoin a bubble? If yes, it does not make sense to have it in our portfolio, does it? Yes and no. If the cryptocurrencies are only a bubble, and if it will explode, it will burn immediately $3.2 trillion. So much is the total capitalization of the cryptocurrencies today. But unfortunately, this will not only impact who owns Bitcoins, but also all the other investors and many other assets that with Bitcoins have nothing to do. Do you remember the derivatives bubble in 2008? If you are too young, I'll refresh you. The derivatives bubble was generated by subprime mortgages. A subprime mortgage is a type of home loan issued to borrowers with high risk of default due to their poor credit histories, low income, or other financial challenges. The value of a subprime mortgages outstanding right before the financial crisis of 2008 was estimated to be approximately $1.2 trillion. These subprime loans were a critical component of mortgage-backed securities (MBS) and collateralized debt obligations (CDOs). The total market for MBS and related securities was significantly larger, with trillions of dollars in exposure. And in fact, when defaults began to rise, the value of these securities plunged, triggering the financial crisis. The US GDP contracted by 4.3% during the recession, and the global equity market lost nearly $30 trillion in value from their peak in 2007 to 2009. The S&P 500 sank so much that it took 3 years to recover. In other words, we had a butterfly effect that was amplified in all the segments of the economy, financial market, and on a global scale. The subprime loans value that triggered the world crisis in 2008 was only $1.2 trillion when the bubble exploded. Today, the capitalization of the cryptocurrencies is $3.2 trillion, more than double, almost 3 times. Can you imagine the impact on the economy if a hypothetical Bitcoin bubble will explode tomorrow? Having 10% of cryptocurrencies or not in our portfolio will not save us from the turmoil that will result and the consequences in almost all the economy sectors. The best investment in this eventuality are not the stocks nor even bonds, but probably a well-equipped bunker with enough supplies to survive for the next 3 to 4 years. Another aspect that is very often underestimated and forgotten in the majority of videos I watched is the Bitcoin whales effect. The first recorded value of the Bitcoin came in October 2009. At that time, one Bitcoin was valued at less than $1. Today, one Bitcoin is worth about 100,000 euro. Who invested in Bitcoin back in the early days had incredible returns. The Bitcoin overperformed every other kind of investment assets for the last 10 years, as showed by this study. Many of these early bird investors are now called the Bitcoin whales because they own enough Bitcoin, we talk about several $1 million worth, to strongly influence the market. At the point that on the internet you can now find whale alert platforms that provide real-time notifications of large Bitcoin transactions, helping analysts to track whale activities. Satoshi Nakamoto, the pseudonymous creator of Bitcoin, is the ultimate whale, estimated to own 1 million Bitcoin, approximately 5% of the total supply. These coins have never moved, adding mystery to the whole Bitcoin history. And what if one day Mr. Nakamoto decides to cash in and sell all of them in just one shot? What may be the chain reaction and the consequent impact on the market? Is this also a possibility? Who knows? In any case, as we already discussed before, if this eventuality happens, there will not be safe haven and every investor will be immediately affected with major consequences in every economic sector. Okay, but then what makes the Bitcoin so attractive? What makes the Bitcoin very attractive is the fact that it operates independently of governments and central banks. Moreover, its supply is capped at 21 million coins, making it a deflationary asset and appealing to investors seeking scarcity similar to gold. In fact, when all the Bitcoin will be mined, there will be 21 million coins on the market, and it will not be possible to mine more. For this reason, the Bitcoin has also been viewed by some as a hedge against inflation and currency devaluation. Moreover, the blockchain technology is now universally seen as a transparent and secure transaction process, which also makes the Bitcoin globally tradable 24/7, making it highly liquid and more accessible compared to traditional financial markets. In other words, Bitcoin can be a high-risk, but at the same time high-reward investment. While it has the potential for significant growth, it requires careful consideration of your risk tolerance, time horizon, and diversification strategy. In my humble opinion, investing in Bitcoin makes sense only if limited to a small part of a broader balanced portfolio. Well, if you like this video, you might also consider to watch this one where I have analyzed the differences between physical and digital gold. Alright guys, thanks for watching, see you in the next video. Bye!